What if the smartest investing decision you ever made took less than 10 minutes to set up? This year, more beginners are discovering index fund investing for beginners, and for good reason. If you've wondered how to start investing with little money, this is your starting point. An index fund is a simple investment that tracks a broad market index, like the S&P 500, which represents 500 of the largest companies in the United States. Instead of betting on one company, you own a tiny slice of hundreds, instantly diversified from day one. As Warren Buffett himself has said, a low-cost index fund is the most sensible equity investment for most investors. Here's why that matters. Most actively managed funds, where professionals hand-pick stocks, fail to beat the market average over the long term. Studies from S&P Global consistently show that after fees, roughly 80 to 90% of active managers underperform a simple index fund over a 15-year period. And those fees compound against you just as powerfully as returns compound for you. Speaking of compounding, this is the engine behind long-term wealth building and set-and-forget investing. When your investments earn returns, those returns generate their own returns the following year and the year after that. Over decades, this snowball effect can turn modest, consistent contributions into significant wealth without you needing to do anything clever. Benjamin Graham, the father of value investing, emphasized that time in the market rewards the patient investor, and long-term market history supports that idea. Now, how do you actually start? First, open a brokerage account with a reputable provider like Fidelity or Vanguard. Both offer commission-free index funds with extremely low expense ratios. Many of these funds allow you to invest with as little as $1, removing the old barrier that investing was only for the wealthy. Next, choose a broad market index fund. A total market or S&P 500 fund is typically a solid starting point for most beginners. Then, automate a recurring contribution, even if it's just $20 or $50 a month. This strategy, sometimes called dollar cost averaging, means you buy more shares when prices are low and fewer when prices are high, smoothing out volatility over time. Finally, leave it alone. The psychological power of the set-and-forget approach is that it removes emotion from the equation entirely. Markets will fluctuate, they always have, but history shows that long-term investors who stay the course have generally been rewarded. As Peter Lynch once noted, the real key to making money in stocks is not to get scared out of them. Index fund investing isn't exciting, and that's precisely the point. If this breakdown was useful, hit subscribe for more straightforward investing content.